Hello, everybody. Stephen Mead here with Domicile real estate for people who love houses. This is our Southern California housing market update for June 15th, 2021. I cannot believe it, but we are here. So, if you were watching us last week, the big thing we were talking about is kind of a softening of the numbers across the board. And I think the big question that everybody has is that continuing this week? And I'm not going to make you wait until the entire end of the video to find that out. We're going to jump right into it. And I'm going to tell you I'm going to preface this by saying what I think is going on. And the answer is maybe. And the reason why I'm saying maybe is we have seen a couple of our things which were retreating last week actually bounce a little bit. And this isn't that unusual. I'll tell you where I think we are in the market is I think if we're in a spot that has been kind of going unabated, rising like this, and then you start to run into little places where you kind of like start bouncing on a bit of a ceiling. And I think that's kind of what we're doing. I think that's where our affordability numbers are suggesting that. And I'm going to talk about why I think that's the point we're reaching on the market. But I'm going to make a really important point to you midway through. So I'm going to say it now. I'm going to say it about 5 more times through this. We take market stats for Los Angeles and Orange counties together. And the reason why we do this is because this gives us a much greater sample size. The bad news about this, and the reason that I want you to pay extra special attention, is especially when you are in a moment where a market may be entering an inflection point where it is changing, you may not see the same results throughout all market geographies and market segments. So what I'm getting at here is we are going to have some overall aggregate numbers for you, and we're going to talk about those because I think they're very important. But understand that if you are looking for 2-bedroom condos in Laguna Beach, your market experience may be different at the moment than what I am talking about and what I'm describing in the market as a whole. You may be at a period of time where there is very, very low inventory and one place just came on the market. There hasn't been one in the past month, and everybody just goes like this on top of it. So even if the rest of the market might be changing a little bit, you might find that your exact market segment is not. I'm in fact running into that exact situation right now with a client, and I'll share that with you. So we're going to jump right into the statistics here with our numbers for June. So let's see here. Go back to the beginning. All right. So one of the things we've been talking about is kind of having this sort of perennial low inventory. And here is the good news. Across the market as a whole, really, this is inventory we have not seen since the middle of January for our under $1 million market segment. For our $1 to $2 million market segment, we haven't seen this level of inventory all year. You'll notice right about a month ago, inventory started rising. It had been pretty steady and low here. And that trend is continuing, right? So if you are a buyer, this is good news. If you're a seller, it means your house has to be compelling. There is a phrase in the real estate business. I've always liked it because it is cute and simple and true. And that is, if it's not selling, it's not compelling. So, if you're a seller in this market, yes, there's still a ton of buyers out there, as we're going to show. But you want to have a very compelling product. I think those memes where they show someone with sort of, a plastic playhouse saying starter home, $500,000, I think that is kind of over. But again, if you've got a compelling product, you're still going to see strong demand, but you need to have a compelling product. So this is kind of an interesting one. And we had talked about maybe that there were some effects from Memorial Day, right? We saw a real dip in new listings coming on the market, and we saw a corresponding dip in our $1 to $2 million segment. So, the dip was real big here in our entry-level market segment. But over the last 2 weeks, these numbers have really climbed back to kind of around where we've been all spring in terms of new listings coming on the market. This is a pretty steep slope, and I'm very curious to see, are we finally going to see that gold rush of sellers, right? There's another economist, I'm going to go off screen share here. There was another economist who I'm not going to mention by name, But his sort of contention is that we are in a market where supply and demand are being ignored. And that if supply and demand were being followed, what we would see is just a ton of sellers coming into the market because prices are high, right? Um, you know, and I disagree with that. I don't think that is correct. I think there are a lot of reasons that sellers put their houses on the market for sale. Price is just one of them. So, yes, prices are very high right now, which is very good for sellers. But I think there's a lot of other reasons that sellers take into account, like, will I be able to find another house? How much will I pay for this other house? Um, a big factor that nobody's really talking about here in California is that California, thanks to Prop 13, when you stay in your home, your property taxes go up very slowly. When you trade out your old home for a new home, your property taxes get set at that new level. Now, in a market like this where interest rates are low but prices are high, that can equal a very big jump in property taxes. That is unpleasant for people. They don't like that. So I think there's a lot of other markets at play. I don't think supply and demand have gone out the window. I think that that is just a very simplistic view that says consumers and sellers only look at where home prices are when deciding to put their house on the market. I think they look at a whole bunch of other things too, and they don't like those other things right now. Okay, so if this is our supply, getting back to the supply and demand theme, we up, right? Now, the real question is what happened to demand over the last 2 weeks? So, if you look at our demand over the last 2 weeks, we actually saw it fell until a week ago, and then it bounced up a little bit for both of our categories. If you're in that $1 to $2 million zone, guess what? It is actually more competitive right now than our under 1 million zone. Interesting. And our demand levels for number of homes that are going into escrow is actually just as high, now as it has been at any point in the past this spring. But I'm going to go off screen share again. I'm so sorry to do this, guys, but I actually feel like I'm looking at you when I'm talking to you. There's really two ways to look at this. Whenever you see that level of homes that have gone into escrow going down, there's really two reasons for that. One, fewer buyers, right? Like, are buyers being pickier, or that market is softening, demand is going down, et cetera, et cetera, et cetera. The other is that buyers just aren't seeing the houses they want. There aren't enough houses to meet the demand for buyers. Since we went through, and we've got really kind of data that supports both ways, right? New homes going on the market slid a little bit, but active inventory is up, meaning there's more houses than there have ever been to choose from. So I'm actually going to go with, I think that we are seeing a little bit of a slip in demand. I think that's what's going on. I don't think this is a supply constraint issue entirely, because frankly, we've got more inventory than we've had all spring. Now, we could have a situation where we have just as many buyers in the marketplace, but those buyers are picky. Those buyers are saying, I'm going to wait for the house I want. If I'm buying at these prices, I want to get exactly what I want to get, and I'm not going to settle for something I don't like. And that could very well be what's happening. I know with our own practice, we're seeing that from buyers being more picky, having a different set of standards. And when you think about it, that really makes sense, right? If you are a buyer and you've watched prices going up, don't you think it's entirely possible that, when homes were cheap, you said, I'll take anything. It's a great deal. I'll make money on it. But looking at the market today, maybe you're saying, you know what? I'm probably going to be in this house 5 to 10 years. I want to buy exactly what I'm going to buy. And I think we might be seeing a lot of that in the marketplace. We would absolutely love to see some survey data on that. So if there are any industry insiders out there who have that survey data and would love to share it with me, I would absolutely love to see that. Okay, so jumping back in, just to summarize, our supply of houses has gone up to sort of this, month ago level, but our demand for houses, we are not seeing the same sales volume at our under 1 million. We are seeing the same sales volume though in our $1 to $2 million price category. Interesting stuff. So when we reconcile supply and demand, we get what we call an absorption rate. And we talked about some interesting data here, right, in our absorption rate. We've often said that anything above 70% is is a seller's market. Anything above 80 is a very strong seller's market. And anything above 90 is Circusville, crazy town. People will do whatever to get houses, right? And you can see bumping up in this 90% level mark in our under 1 million category. 1 to 2 million, this has always been a little bit of a softer market, but I'm still looking at this data, seeing these downward trends. And I feel like something's got to give when I see these numbers dropping. When you see these absorption rates dropping, that's not the kind of environment that is supporting rapidly rising prices. But we have sellers who are still behaving that way. So I'm still very much of the opinion that we're in a market that is in a little bit of a flux. It may be transitioning from a wild rocket ship ride market to more of a just strong and steady market. So if we look at our closed prices here, and I give this word of caution constantly, right? This is based on things that were negotiated 4 to 6 weeks ago. Look at what happened. We did see a big price jump in this upper end of our market, that 75th percentile. But we saw pretty decent price growth too in the last month or so in our 25th percentile. In fact, it's been really steady. But look at this. It kind of has a little bit of a flattening look to it. And, I believe that's where we are. I think we're in a period of time where these prices are moving up at a more slower rate. But understand, and I'm going to say this again because I've said it a couple times in this video, and I'm going to probably say it a third time. Your exact market segment may be behaving differently. In a market that is starting to change, not a steady state market, in a changing market, you will notice that those changes do not affect all geographical and price segments the same. So, as always, you really need to pay attention to data in your exact market segment that you are looking in right now if you're a buyer. Same thing if you are a seller, your exact market segment. If you want help in understanding your exact market segment, you can definitely reach out to us. So this is another one that we did, a new stat that we incorporated into 2021 called percent still active after 14 days in the market. So our absorption rate attempts to give us a look at what is happening when we're talking about just in general, how do we reconcile the number of homes coming on the market versus the number going into escrow? That's great, but that doesn't tell us about the timing, right? It doesn't tell us which houses are going into escrow. Are they the recent listings that are just hitting the market? Or are those the listings that maybe have been sitting and they're finally getting scooped up, right? Those things tell us different things. So the way to look at these numbers is this is sort of like a windsock at the airport, and it tells you, is our market getting more competitive or getting less competitive? And what I think is interesting is, look, we had peak numbers here a week ago or so in both of these categories, and they both dropped. Both our under 1 million and our 1 to 2 million. And that tells us that the market got more competitive, that the homes that just hit the market are more than likely getting snapped up. So again, we've got some conflicting data in this data set. And I'm not done yet. Our list to close ratio, our 1 to 2 million, this is fascinating, right? Typically in a rising market, it is the entry level properties that get this sort of overbidding phenomena. And while those numbers are very strong, right? And looking at that, we are still well over 100%. Look at it's this luxury market that's really been crazy and been bumping on this 104% average. I think that says a lot about the types of people that are in that market moving up, or people that are either have a lot of motivation to buy in that luxury market. Maybe they already sold their home and they need a place to live, or it says a lot about their confidence in economic factors and other things. So very strong numbers. Then if we look at our days on market, right, this was kind of the interesting story. We saw bumps last week in both of these, and look what's happened. We actually reached a new low in our entry level market. We were at about 17 days. Our previous low was at 18 days. So we actually reached a new low point in the last week, right? I mean, that is nuts to think about. So what does that tell me? It tells me that the last week was pretty interesting. that in the week that we just had, we've seen a little bit of a sort of rush to buying in that entry level segment. But if you look here in our $1 to $2 million, that leveled out. I mean, these are still extraordinarily low numbers, right? If we want to say the market is quote unquote getting soft, we need to see these numbers start to pick up into the 20s like this. We need to see them rise up here, and we're not seeing it. It's not happening, not yet at least. Now, if we look at our affordability statistic, this is indexed to June of 2018, right? That would be our baseline. So what this graph shows us is how expensive our homes or the payment on a median priced home relative to 2018. Well, guess what? We're right here at about 17%. I don't think that's out of line with wage and inflation figures. I really don't. I think that's right in line exactly where we should be. We do not have a market that is completely overreacting. And if you look at this here, this spring was crazy. It ran up, but look at where we are the last 2 months. This is kind of more of a steady increase, right? Huge increase in the spring, steadier in the last 2 months. I think that pretty accurately describes our market. Now, those of you who are kind of the naysayers, I'm guessing what you're hoping is that you're going to see this curve and start to head down over here, cresting like a wave. I don't know if we're going to see that. I think inflation, I think rents, I think there are just too many factors that are saying this is the appropriate prices of housing. When I say price, I don't mean the sales price, I mean the payment level, because that's what consumers actually are paying, right? So, again, I'm going to say this a third time. Whenever we have a market that is kind of showing some of these mixed signals, that's really a sign that you have to be hyper local with when you're talking about what are your market conditions in your market segment. We divide this by under a million and 1 to 2 million, but the reality is condos often act differently than single family homes. That's a big divider. And really sub-geographical areas, even within Orange County, right? Inland Orange County versus coastal, one city versus another that's 10 miles away. Planned communities that are newer versus older established communities. I think whenever you're in one of these markets that might be experiencing some flux, you're going to see differing results in these different markets. We've got one more slide that I just kind of like to throw up here, show everybody a little bit regarding mortgage rates, because I think that really is the thing that has the potential to disrupt our market. And if you'll remember, earlier this spring, one of the things we talked about was how reactive our market was to interest rates. And I think we might be seeing that again, right? Rates peaked and then they slipped again under that 3%. We've really, for the last, almost 2 months here, we've been right around this 3% range, kind of holding steady. And whenever we see a little bit of a drop after a little bit of an increase, I think there's a little bit of a mini rush by consumers to jump into that market. They're afraid they're going to miss their boat. They want to get something. So, it's really interesting to be in a market like this. I wish I had kind of some more solid predictions for you, but the fact is we do have mixed data. I think we're in a state of flux. I think we're bouncing up a little bit on a ceiling. I don't think we're going to see a big set of sudden huge price increases. I think we're going to see slower, steadier growth, because I do think that the market just isn't really ready to bear prices going considerably higher, payments going considerably higher. It's going to take something like a big drop in interest rates, something like that, to fuel a price increase from where we are today. I think we're going to see more inflationary level pricing increases. However, inflation seems to be pretty high at the moment. So, that could fuel some stronger prices than we would otherwise see. Anyhow, thank you guys so much for watching. Questions, comments, we love them. Do not forget to like, subscribe, hit that notification bell. If you are watching us on Facebook, absolutely check out our YouTube channel. There should be a link in the description for that. And subscribe so you can see all of our videos. Anyhow, we'll see you next week, everybody.